right, I'm trying to make another video. And this video is going to be part 2 of our case study that I sent a couple days ago of Orsted, this company that was going to participate in 50% of every single, or in aggregate, 50% of all of offshore wind in the whole world. And, you know, I made a various points that you can't look at EV to EBITDA because EV to EBITDA changes when you've got a fast-growing company. You can't look at ROIC for a whole number of reasons, including the fact that when you're in the construction period, you don't have any net operating income, and you're dividing it by a ever-increasing denominator for the invested capital, and most importantly, when you have an EBITDA that's kind of constant and a accounting investment value that decreases, the ROIC is going to be all over the place when you have a really, really fast-growing company. Okay, and then we talked about all these nuances with different regulatory regimes and hedging and renewable resource calculations, and the issue that the cost of capital was changing. Now, just before, I have to tell you something else. I have been going crazy. Fred. Fred, I love Fred. Federal Economic, Federal Reserve Economic Database. What a wonderful tool for free. And suddenly I couldn't use my little techniques to download the data to a file. And I was so depressed. I thought, oh no, especially when you want to do things like compare the S&P 500 with growth. With dividends, not without dividends. That's ridiculous to use the S&P 500. What a silly index that doesn't include the dividends. If you want to compare that to the GDP growth and adjust for inflation, do it real. If you want to perhaps go to the World Bank and download all those commodity prices that are beautifully shown, but you want to put them in real terms and divide them by an inflation index. For all of those things, having a tool that will get that Fred data really easily is useful. And suddenly the stupid thing didn't work anymore. And I just figured the Fred out now. And I just figured the PV Insights out, I think. I didn't, that still works. The getting the database for that on solar costs. So you can go to my website and get that stuff. I'm putting it all together. I'm not finished. And then I've been working on this file that I think is so interesting and important, where you consolidate a whole lot of projects, build one each year, and then see what happens if there's different growth, if you're earning different returns relative to the cost of capital, a whole bunch of things. And then you just make a little macro that sticks every single project in and then consolidates that. And from a theoretical standpoint, I find that so valuable. So those are 2 kind of files I've got to get on the website, and maybe I'm going to put it like a little update page. The third file, which is so exciting, I think, is I've now looked at actual models, and they sometimes, I'm sorry if I'm going to piss you off, but they sometimes suck. They get so heavy these days. And if you've got a circular reference that just clucks along plus a goal seek, and you want to do the circular reference, goal seek, circular reference, it can take unbelievable amount of time, especially if you have a template model. And I've just finally really got it. I really got that stupid thing, and we put withholding taxes in. We put interest deductions on the shareholder loan and limitations on interest deductions. We put all sorts of different DSRA techniques where you can look at a maximum level and change it to a debt reserve fund. we put put the future fees and all of these in Africa. I just hate it when you have to pay. You say, oh, the interest rate's not that high, but we have to pay political risk insurance, stamp tax, blah, 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 withholding tax. Oh, my gosh. And then you put that in debt sculpting, and you put that with multiple issues, and then you try to figure that out with taxes, and you've got unbelievable circular references and a mess, a real mess. And we've cleaned up this mess. I'm going to show you how that works. So I talked about, and then this last one, which is the biggest one of all, this stupid finance.yahoo.com doesn't let me get this data the way I used to get it. But now you can use some little API thing and get the stock prices still, so that the thing that used to be kind of so easy using workbooks.open, that's all set. So that's just a little introduction. I'm going to make some videos sometime in the future. You can see I don't really give a here's what I try to do. I try to make the videos and purposely not look for 1 second at this silly thing that says I got 2 views or something like this. Who cares? I just want to document some of these things before I die. I'm writing this book about it all. I'm putting all this stuff together. Now, where I left off is we saw this company gets a premium of WACC, which is kind of a bullshit thing, because they've got a development company, really, a construction company, and an operating company. And somebody quite sensibly said, this is just a review of all the stuff that we did before. Somebody wonderfully made this wonderful comment that, you get this question, and he said it kind of nicely. I'm going to say it a little more meanly. You get the same question. It tells you, investors do understand that you have a valuable portfolio of operating assets. And what that means is you got some low risk, boring as shit assets, really boring assets that take a really low rate of return. You can sell the piece of these assets off and get a probably high profit. But they don't like all the bullshit. And that's what he should have said. And they don't like what you really are. If you're developing these projects, you are a venture capital firm. I should have said that. You're taking speculation in all of these different projects around the world, and you're going to go God knows what in Latvia, in Korea, in Japan, in Australia, where they've never built these offshore winds, in Spain, whatever. They kind of got out of Spain, I think. And you're going to try to develop brand new assets. And when they did it in the U.S., God knows what they did. God knows what they did. When you develop an asset, you should have a really small development cost. And for some reason, they seem to have $1 billion invested before they reach this complete wacko thing called FID. Really wacko. Really wacko. I don't know when I give this presentation to these bankers, should I be a little more aggressive? Maybe. I think I will. I think I'll get, when I say confusion with FID, that's a little more polite. So what this company really is, it's a venture capital firm where if you're going to assess development assets that could work or could not work, how could you do it with some whack premium? God damn it! You should put some probability analysis in that, just like anybody who's investing in some wacko stuff like my daughter who lives in that Silicon Valley and can afford anything. She's not one of these people, by the way, at all. How could you not start with probability? And then, if you're a development firm, the biggest deal is to not start wasting a ton of money. You got to conserve that upfront money until you've got a proof of concept, until you've got something real. And this is where they really screwed up. They seem to have made all these expenditures before the FID, whatever the hell that means. They made all these expenditures and they had way too much, and then they had to cancel the project. You need, if you're development firm, to conserve those early expenditures. You can write the decision trees and probability analysis. And then the second thing, and they go to the FID, and then there's some kind of quasi-construction company or EPC company. They sign contracts, they procure equipment and all that, and they should do that well. They should be so good at that. And they shouldn't have to suddenly say, oh my God, the cost just tripled because we can't get our boat. What in the heck is going on with that? And then the risk of a venture capital company and a construction company is so different. And then they get to managing the boring assets, and basically they have to put their finger in the air and say, is it windy today? If it's windy today, that's good. And then we go home. Because what else can we do? We gotta manage our O&M a little bit, and maybe they're good at that. Okay, good. Get those boats out there and contract some people. That's really important, obviously. But then for that, you got to present the case. And that's what that analyst said. Show us how much cash flow you have from the boring stuff. We need to see that. We need to separate out the company. So I didn't put that in the last one. So now what we're doing, again, I'm doing this a little bit from a timing perspective. And now I'm worried about not having enough time. So I'm going to talk about putting all of these concepts into an actual model. And here's what happened. I received a model, and I disguised this model. And this guy from the financial institution or whatever said, "Oh, do a case study." And I said, "Oh, okay. I don't really have a case study." Luckily, somebody showed me a case study. And it was done by, of course, a private equity firm. I don't know. I was just on the phone earlier with this private equity. They all want really high IRRs, obviously. So this case, I'm going to describe this case. And the idea of this case is, again, no Excel, no Excel, but showing you how things work. So this is a case of 12 different renewable energy projects. Now, where I had to do this practice thing is a place that's flat. Okay, that's all I can say. It's not Switzerland. So, there are the man said, "Why are you talking about hydro when it's flat?" He was right. But it's renewable energy, and please don't turn off the video. Well, turn it off if you do. I won't look at it. I don't care. But if you're interested in wind or solar, this case applies just as well. It's got resource risk. Okay? So there are 12 projects, and interestingly enough, kind of related to the last thing I talked about, some of the assets are operating, and we have to study how we would value an operating assets. That's out of the 168, 24. 22 are under construction with contracts, but they haven't made all the expenditures. So if you invest in those kind of projects, you have to invest in a cash outflow and an inflow. And the risks of you have some construction risks, and you don't know what in the heck's going to happen when you finish construction exactly. You don't have any operating history. How do we put a risk and a discount factor on that versus the operating thing? And then they put these all kind of on some rivers, I guess, and they have 117 megawatts that are going to just earn this fantastic rate of return. You should just be desperate to value these things. They don't have any construction contracts, most importantly, revenue or PPA or feed-in tariff contracts. All of the stuff I talked about in the last video. And they don't have anything else. Okay, these are venture capital. These are kind of got some construction risk, and these, how much risk do these things really have? That's kind of more interesting. So when I look at these, we're gonna look at a disguised model, and I'm going to comment on some modeling stuff. Okay, I think I'm allowed to do that because some of the techniques were so shitty and you couldn't make a presentation, you couldn't understand the risk, you couldn't put the three categories really in separate kind of frameworks to figure out how you'd value a development asset, a venture capital kind of asset versus a construction versus an operation kind of asset. Okay, so how do you verify the accuracy of the model, the structure? FAST, flexible, accurate, structured, transparent. No, I use accurate, not appropriate. And then I made a little revised model, and I used the same sort of stuff that we showed you, where you take different assets, put them in a portfolio, get the timelines defined really carefully, and then consolidate them up. And these, I'm going to go nuts on these people. They think, oh, no, I do a three-statement financial model. I'm a hard-ass, kind of really good associate analyst, whatever the hell they call these people. Oh, I'm so good, I make a three-statement model. What a bunch of bullshit. You got to make a model that really, in this kind of analysis, that can do some good consolidation and really display the cash flows and understand the project IRRs, understand the potential for selling an asset after its risk has gone down, that kind of stuff. It's a lot more interesting than making a little balance sheet and computing the return on investment. Now, before we go any further, I'm going to just give some background on run-of-the-river hydro projects. So again, I'm just practicing this kind of stuff. And I went to whatever, get some pictures of hydro assets, and they had some nice diagrams. What they do is they take advantage of gravity, so you need a hill. If it's run of the river, you don't put some big, gigantic gate in here that shuts and opens. What you do is you divert the river, though. You put something called a weir here, and the river comes flowing down, and you take some of the river and put it in some pipes that really concentrate some energy. And when it goes down with the gravity and the fast flow of a river, you can use this fast flow, concentrate it, get it in a turbine, and send it out. Here's a little more. So here's the weir, here's the river, and then it turns back to the river. You take you bring it back. Here's some pipes. You've got a generator, and that's how it works. Now, here are some pictures of weirs. This is kind of good. I found this. The man, weir's a simple barrier to raise the water level on the upstream side. The weir is a simple. He put that. Water can flows. This is good. Maybe it can flow over the crest of the water. Okay, simple. That's okay. So that's what a weir looks like. And if you make a model, I almost think you should put a picture of this stuff right in the model. And then I try to find pictures of these kind of things. Here's the river flowing, and somewhere up here you must have had the weir, and here's the pipe coming down, and it looks like a mess. It looks kind of crappy. It kind of destroys some stuff. Here's another example. This doesn't look quite as bad. You must have diverted the water up here. It's kind of on a hill. You can see it coming down, coming into the generator, and there's a transmission line. Okay, so that's what it looks like. And then the key to this is, somebody told me this. You can teach this in half an hour. It's just this wonderful formula that comes all from Isaac Newton and Albert Einstein. There's gravity constant, because a lot is about gravity. So what you do is you measure how fast the river flows every single hour, every single second, whatever, and you do meters cubed. It's in volumes. You multiply it by how much the head is, which is the starting point from where you divert the river down to where you put the pipe. So this head is just a constant. And then you multiply it by this gravity, and this is somehow meters, and meters cubed come into kilowatts, and then you have efficiencies, which is not that big a deal. It's kind of maybe 70% efficient or 90% efficient. You get these things and they're pretty flat. So the only variable, it's like wind speed or solar power, is how much the volume of the water flow is, and that depends on how much the rainfall is. And here's the issue. Just like we have potential effects on the wind speeds because of global warming, maybe in solar you have the potential effects on the heat because of global warming and things like that. Climate change, yes. I don't think it's a hoax like okay, and we need to get that. Now there's a little bit of complication. It might be raining really a whole lot here, so this could be a year in time. And so there are two big rainfalls here where the Q is this thing up here, this flow rate, and then you sort it out, you put it all together and put the top up here and the bottom up here, the fastest Q rate, and then you change it into a percentage. And you don't make you compute this little thing every single hour, and you decide how big to make your turbine, and you don't make your turbine to collect it all up here, because then it'll just run for 1 hour here. You could put it down here and it'll have a really high capacity factor, and you have to do kind of that's how the capacity factor is defined. We have every single hour, and we just figure out how big to put the turbine in. And that's enough on the renewable energy. So again, I'm afraid of these people yelling at me, but it's just something that's weather dependent and something that you can get historic data on, but that historic data might mean less and less, and how much historic data do you actually have? So now let's get into the modeling, okay? And let's see how this works. So I said it's oh shoot, maybe I'm repeating myself a little bit here, but there are multiple hydro projects. There are different stages of development. The selling company had a PE, private equity company, make their little model. Okay, so here's how, if you open their model, here's what it shows. It shows the projects, and they do say, well, we've got some operating projects, some projects under construction, and then some pipeline projects which have nothing, okay? And what they try to gear you to is suggest that they use equity cash flows. So one issue in this model will be, should we use equity cash flows? And basically there's a little bit of an error here because of timing, because they really made the valuation at 1st of January, I think, not 31st, or it's vice versa. I had to work it out. And then they say use a 10.3% equity target IRR, and then you should be willing to pay 72.5. And then for all of these projects that are just gleams in your eye, that are venture capital, use a higher equity IRR. At least they did that. And then you should be willing to pay $22 million, plus you should be willing to pay an earn out, meaning if these projects are successful, you're going to give them a little more. So you should pay $22 million just for the pleasure of having a project that may or may not work. Okay, and then what I did is a little bit of further analysis, because in the models they show you what the capacity is. So this is the amount of capacity, 117 megawatts, 22 of construction, 24 of operation. This is how much they invested. I got that by just adding up the depreciation. This includes the future capex they make and the historic capex they make. They have some debt associated with these projects, and then they put the debt associated with the future projects. You know, debt, project finance debt is something beautiful. It's something that Orsted didn't do. The banks do hire engineers, consultants. They review every single contract in great detail. They make sure you have the contract signed before they even look at anything. And they look at the revenues, and then they look at the models in details and make downside analyses and everything else. Orsted had nobody checking them. But these things are speculative. There's no checking. These things are real debt. So maybe this equity, capital means something here. This thing, I wasn't even sure what the debt, but they had some existing debt apparently. So the equity they invested in these projects was here. If you take the net present value at their wonderful rate of return, it adds up to this. Is this 72? I think so. It adds up to 65. Here was that little factor I had to do. Okay, whatever. That's enough. Okay, if you pay 72 million, you invested 44 in the equity. That's quite a premium. I think that's 64%. They're trying to get a big a premium from selling these assets, presumably because they've been earning a really, really high IRR. And if you look at their equity IRR, they've been earning 28%. How in the hell they've got 28% from feed-in tariffs is an interesting question, and that's what you might really want to look at. So really what the premium comes from, you would be willing to pay 10% when these projects were achieving 23% from the feed-in tariffs. The same kind of thing here. They're earning 29, 30, 58% with this debt assumption and everything else. And then you're supposed to, and then if you don't include the earnout, you'd be willing to accept 17.47. So you're going to, because these wonderful projects, which are gleams in people's eyes, have such a high IRR, you're going to be willing to pay the 22 million. That's really kind of what's going on. If you have to describe this, I think it's important. So again, I'm restating this. They're buying operating assets. And what they might want to do is get the cash premium. They might want a premium from these operating assets, or if you want to say something fancy, monetize these assets so that they can then fund some of this future construction and put equity, call that equity in construction, which is totally, absolutely appropriate. Okay, and then the real question is, how would you value these differently than these? And it depends on the contract structures. It depends on the reliance you have in resource estimates. Some of these assets had some actual operating history, and the amount of operating history for these versus these would give you a very different value of assets. How you actually do that is the challenge. And then we have development assets. And you have to think, what makes these so special? Do they have some kind of unique right to develop these assets? Did they pay something to use the river? Something could make this development really worth something. And then can they really achieve those enormous rates of return? Because and that all depends on the probability that the assets will actually be developed. So before we start getting into all the modeling issues, conceptualize this stuff a little bit. Now, here's what they did. Here's how they presented the assets. They made these things, and you can see the different assets going into service. This is where they have this crazy assumption of the new debt, and then they have the FCFE, the free cash flow to equity. Okay, which I love for project finance. I think equity cash flow analysis makes a whole lot of sense. And then we can talk about the risks of different phases. And I just made some comments that, if you have these kind of risks, you have risks of, do we have a wrap on EPC contracts? What's going to happen to our O&M and resource? Our insurance, I think, is a much bigger issue that's coming more and more into play. And we want to know, the big deal is what's not in here. And the kind of, if you get a model like this, what kind of stuff would you absolutely demand to get immediately before you start doing some scenario analysis or sensitivity analysis? That's part of this case. Now, again, I think making a terminal value in these cases would be a complete joke. What they did, they used to build, own, transfer, or a BOO, that's build, own, operate. So these things, if they have a PPA contract of 25 years, they have to give it back to the government. Shovel ready means they're actually constructing, I guess. These ones that are operating, you can see when they started, this project one had a lot of history. No, that's the construction start date. This model, I should say, this is really, really important. It was given at the very end of 2024, very recently. This project would have had 2 years of data. This project would have had a half year of data, a little bit more, and then a full year of data. Same with this one. So we've got 3 projects with data. And this project with the BOO, you have 20 years of a PPA, but then you have 100 years of life after these. These hydro projects last a really, really long time. Okay. So the first thing is, remember I said, okay, you show these kind of line-by-line things for the projects, and then this. Let's look at this formula. I'm sorry. The length of the formula is the first thing that comes out. If you think you are smart by making a formula like this, you should go to Excel jail. You should not be allowed to touch a spreadsheet if you make a formula like this. You should not divide by 1,000,000 like this. Just put the stuff in USD. Don't put it in millions. What a waste. It's just going to confuse the heck out of you. Okay, so that's the problems. No, there are a heck of a lot more problems. Look at this over here. They just kind of zeroed out things. They didn't keep the formulas across the column itself. But look at this. You grab data from another sheet and put this here. It makes it impossible. It makes it impossible to start tracing things. If you're going to use project inputs, you stick them over here as a driver. If you're going to put all of these inputs, this one formula has so much wrong with it. And it's hard to make it easy. And it's really hard to make it easy when you think you have to consolidate projects the way they're consolidating projects. And this kind of stuff, I get the feeling that people still think they're fancy in Excel by using these kind of projects. So first thing I did was said, screw that. Let's make all of these projects separate. So we make project one. We put, these are much simpler. I'm not showing you the formulas. They're all simple formulas. I promise you, when we put all of these flags in here, and you put whether it's a historic period, you've got an actual period or not, and we really want an extra actual period. And then you put when the construction starts, you put all the drivers over here, okay, and you put your little true-false flags and you make them simple. And then you have something really, really important. You can see that this capacity factor that we talked about in the Orsted case, and basically it reflects the river flow, is 72%. It could be okay. They could have made a small turbine relative to the river, and maybe that's okay. But I could not imagine getting this model and not looking so much more deeply. This is a operating project. And then you look at this one, remember it started for a whole year, it had a whole year, and the capacity factor was 63% instead of 72%. That is an enormous difference. And then it's supposed to go to 72% forever. And we actually have a whole new year of data. So the first thing you would do is demand, give me the damn data for this thing. Otherwise, I'm going to throw that model back. Give me a data room. And then you want to look carefully at all of those river flows and the history of those river flows. Okay, and then after that, you can put the operating, the inflation rates and all that in. They assumed a 3% inflation, which is kind of conservative. They put everything in USD because the tariffs were in USD. Fine. Okay. And then we look at the tariffs, and there were some flags because the tariffs went up and down, and one of the projects was not in USD, and you'd have to put the exchange rate in, and I put the exchange rate all the way at the top so you could easily switch between a USD and a local currency. And then you had operating expenses. And this is the thing that scares the hell out of me these days, is that insurance was supposed to be 55 million, or they put that forecast, the actual was 132. You want to put that and be able to show just exactly what we're doing right now. Show the actual versus the forecast. In this case, the O&M was a lot less. Maybe that's good news. But then you can look at other projects and it wasn't such a good news. Okay, so we have our, and this is the way, it's so obvious to do it like this. You start with how much you generate. After you have how much you generate, you put in some inflation statistics, and then you put your revenues and operating expenses in, and then you get your EBITDA, which I stopped here. I stopped here. Okay. With the EBITDA, you can compute, you can take away any CapEx you have. So now I changed it to project 3, so we have some CapEx. And what I'm doing here, it doesn't show at the bottom, we're putting different projects in. And instead of trying to just group them all in one place and put that gigantic, horrible formula in, you're separating it out. And then you can compute your depreciation and get your, project. You can get your pre-tax IRR, just your EBITDA versus your CapEx. Gigantic IRR. You can compare this to the pre-tax cost of debt. And the equity return should be really, really high. And then you can compute just your taxes, assuming you don't have any financing, and you get your after-tax IRR, which is, again, enormous if you've got a reasonable interest rate. And then you can take a PV. Now, when you take a PV, these people don't want to touch Excel. They don't want to touch Excel. If it's just an annual NPV, you put a false in, and that doesn't take the enterprise value back here. It takes the enterprise value to wherever you want to start the valuation from, which is what you should do. Okay, and then you look at the EV to EBITDA ratio, and you see it's going down, and you see anybody who's going to stick an EV to EBITDA ratio in this valuation is an idiot. Okay, now whenever I look at the equity and debt, I'm not showing all the debt calculations. The very first thing is I would want to take project by project. So this is 2 projects. I hid the project names, and then this one has a tariff that declines. This one has a tariff that's flat. There's a whole bunch of opportunity to refinance. That's why kind of this equity IRR is a little BS. We'll get to that in the next video. Okay. But at least I can see the cash flow patterns. There's a little bit of inflation, so the cash flow is going down. There's an overhaul cost, the assumption they're making, and you can question all of these things. But the big other thing I want to also mention, project IR 19%, 16%, equity IR 43%, 31%. When it's like this, and it's a development project, and you get these enormous rates of return, I start saying, if it's really that good, is it too good to be true? And if it's too good to be true, it probably is. Is the government just giving you these great tariffs, or does the government know something you don't know, or you just come perusing them? What's going on? Okay, so then we take these things. If you take these things, there's a little database where you put all the inputs, all the megawatts, and then all the availability factors, and finally all the capacity factors. And we have some optimistic capacity factors that are gigantic. Okay, and then what you do is, to make the project by project kind of analysis, what you do is you grab them from the database, use an X lookup, a simple little X lookup, and that's the driver. And then you change the project name around, and you do that. And that's a lot harder to do and a lot more interesting than a 3-statement model. And then you write a little macro. And you don't be afraid of a macro. And basically you make a little template model. Oh, shoot, I'm glad that didn't mess up. You make a little template model, and then so the template model says take project 1, and basically you're changing project 1 to project 2, copying this to a sheet name, and you've got a whole list of projects, and you consolidate these projects using an old-fashioned little Excel thing which says make a consolidation from the start to the end, and you can put everything together. Okay, and it's a little more advanced than your basic little models. And then, now we could compute for each project the enterprise value or the equity value. And there are arguments for both. I think perhaps equity value if you have a project that really does have project finance. Okay. All right, so I suggest you do it either way. And it's always cash flow that drives everything. I'm just reading my little notes. And the big deal is, how do we take account of the different risks of the different kind of projects? And to claim that you can somehow scientifically do that, and this is, I was not irritated enough by Orsted's little premium to the WACC, which is the industry leader. Oh, God damn it. Here's the way I suggest you extract using an indirect function in Excel. You extract all these different projects. I put a 7%, this is project discount rate, not equity. Maybe that's like a Orsted WACC. And then I said, well, we have a higher risk in construction. Now, again, this operating project, it's so dependent on getting actual data. If you had 3 years, and would you really be able to show some solid trends and not show that the river flow is going down because we have less rainfall because of global warming or something like that, and show that the insurance cost is reasonable and all of that stuff, then you could have a lower discount rate. But if you don't have any history, I think you'd put a lot higher discount rate. What this is, the realistic thing is you talk to your client about it and see what's reasonable. But there certainly should be a different discount rate than just saying, oh, let's put 3% above our WACC for every single project. What a ridiculous thing to do, really. And then I said, for all these development projects, at minimum, you're a venture capital company. You're going to put, number one, a higher discount rate because nothing is given, not the tariff, not anything. And once you have a higher discount rate, you've got to put some probability. So if it was early development or advanced development, I put a little bit different probability, and you'd have to discuss that carefully with your client. And then you can show the project IRR. These are extremely great project IRRs. A lot more than the 300 basis points above the WACC. Show the after tax and see if there's some outstanding debt, and you can get the value of the equity. I said, let's not deal with anything like that. And then this value of the equity, that other thing had 72 million plus 22 million, so whatever, it's 90 some million, whatever. This, now we're getting 56 million. Almost all of it's from operating assets, a little bit from construction, and this little development piece, which how you would structure the earnout is kind of interesting. Once it's developed, it's really not. It has to be developed, and it has to have an IRR that's bigger than your kind of target IRR, and how you would give credit on these kind of criterias and how you would put the triggering points is really kind of interesting. Okay. Then I did a sensitivity. I just took this little thing here and put in, I just said, let's make all the capacity factors going down, because we really, really need that. And just to illustrate how important that is, I put 65%. That's a pretty good capacity factor. You really have to study the resource studies and get what's happening. And now the value goes from 56 down to 30 million. You get no value because they put really high capacity factors in for these under construction projects. And well, you just have to get comfortable with that, and it just illustrates the importance of the issue. Okay, getting that down. Okay, and now one of the things I didn't do, remember I said you could consolidate this. If you were really doing an advisory, you could consolidate all of these assets and then look at how these things would realistically be financed. We've got the cash flow coming up from one. We've got the use of proceeds coming in. We've got a financing on some of these things that are under construction, and we put the exact financing terms, and you see how much of this money, when is this money going to run out when you have some development projects. It's kind of like venture capital again. This is like the angel capital or something like that. And then you're going to have to probably find a lot more equity. And you put this consolidation thing together, and now, okay, then you can make your three-statement model good. Then you can make it. Okay, and let's just look at some of the practices of this company. I use the FAST kind of framework to do it. Okay, and the model should be able to be flexible, like we did some scenarios. It should be able to, of course, change all the dates very easily, take projects in and out. What happens if we want to add a project? That you can do with that framework for putting the separate projects in the database. It should be accurate and contain some little audit sheets, and some summary, some statements, and some tests. That you can be really flexible. It should be structured, just like we showed. The first one didn't even show you the debt balance. We want to show that the project IRR, work from the project IRR down to the debt, and then get the equity IRR. Okay? And the model should be transparent. I already talked about those horrible equations, and I think they violated this. So if you're adding new projects, how do you put project 13 down here? Whatever, and it would be a real pain because of those horrible long equations. Here, in this case, look, I told you before that they didn't, they violated this really basic thing by stopping. What happens if you delay a project? And God knows what's going to all happen. The accuracy. They didn't put any sum columns down here, and they didn't have any tests. And what else did I complain about? Oh, they took all that loan interest from a different sheet. It was such a pain, and then they put these formulas in, so to try to figure it out and audit it. Here, the lookup function, which is fine to use the lookup without V or H. That's fine. Divided this time by 10 to the 6. Okay. Then, in terms of structuring the model, I'm just reviewing kind of what I said, but Here's what you do when you're financing. You put a sources and uses of funds statement in, make a cash flow waterfall, see how much cash goes down to the equity, see how much equity is invested, and you have to, there was no structuring of the project. It's not so complicated really, but that's, even if you're not doing project finance, which I was told you're not, you still want to understand what's happening and how are they financing these projects, and then how are they returning the funding. Okay, and finally all these long formulas and disgusting things, making the model totally non-transparent. So I need to stop, and this took about an hour. So far I took 2 hours.